Disclaimer.
AG here, and before you ask, yes, I'm fully aware my initials match the chemical symbol for silver on the periodic table. After what happened Thursday, let's just say the universe has a sense of humor about these things. But while the coincidence is amusing, what unfolded in precious metals markets this week is deadly serious for anyone holding dollars or planning for retirement. Thursday, January 23rd, 2026, 45 years. That's how long silver stayed below its 1980 high, trapped beneath a ceiling that seemed unbreakable like some kind of financial curse, until Thursday morning. At 10:47 a.m. Eastern Time, spot silver crossed $100 for the first time in human history, ultimately reaching $103.45 before markets closed. And here's what matters most. I'm not talking about inflation-adjusted numbers or some theoretical calculation that economists use to make old records look impressive. I'm talking actual nominal dollars, the kind you check in your brokerage account right now, the kind that determine whether your retirement plans work or fall apart. If you're holding physical silver, or you've been watching from the sidelines wondering when to make your move, what happened? Thursday isn't just another price spike that'll fade in a few weeks. It's a structural break in a market that's been squeezed for 5 straight years, like a spring coiled tighter and tighter until something finally snaps. This is the most important 48 hours in precious metals history since the gold standard collapsed. And your retirement portfolio needs to understand exactly what just changed in the global financial architecture. Picture this. Somewhere in America right now, there's a person who bought silver coins back in 1981 thinking they were catching the next wave after the Hunt brothers peak. They held through the 1980s recession, through the dot-com boom when everyone said precious metals were relics, through the 2008 financial crisis, through a decade of zero interest rates, 45 years of holding, watching, waiting. And on Thursday morning, they finally broke even in nominal terms. That's the psychological weight silver has carried for nearly half a century. Think about this for a moment. Gold surpassed its 1980 record back in 2008, nearly 2 decades ago, during the early stages of the financial crisis, when central banks started printing money like it was going out of style. It took silver 17 additional years to accomplish the same feat, and most investors stopped paying attention somewhere around year 10. They moved on to tech stocks, crypto real estate, anything that promised faster returns. But here's where it gets interesting. When silver finally broke through $50 last October, something fundamental shifted in the market. The patient metal, the forgotten stepchild of precious metals, suddenly had everyone's attention from Wall Street to Main Street. Let me take you back to 1980 for context. The Hunt brothers, 2 Texas billionaires named Nelson Bunker Hunt and William Herbert Hunt, decided they wanted to corner the silver market. They accumulated physical silver and futures contracts like they were collecting baseball cards, at one point controlling nearly half of the world's deliverable supply. On January 17, 1980, they pushed prices to $49.95 through sheer market manipulation and buying power. It was spectacular, audacious, and completely unsustainable. When regulators stepped in with new rules limiting position sizes, the market collapsed within weeks. The Hunt brothers lost billions, and silver investors learned a painful lesson about the difference between artificial squeezes and genuine market fundamentals. Then came 2011, when silver climbed to $48.70 during the great commodity boom. Oil was soaring, copper was setting records, and money was flooding into hard assets as the Federal Reserve kept interest rates at zero. But when the Fed signaled tightening and the European debt crisis spooked markets, silver crashed again, falling back below $30 within months. For decades after that, $50 became this psychological barrier, this ghost from the past, that silver couldn't escape no matter how hard it tried. Traders would sell at $45, taking profits before the curse struck again. October 2025 marked the first time silver genuinely crossed that $50 threshold and held it for more than a few hours. No manipulation, no bubble dynamics, fueled by easy credit, just real supply and demand pressures, building after years of deficits that most investors did not notice or care about. Industrial users were quietly panicking. Solar panel manufacturers, electronics companies, electric vehicle producers, they all need silver, and they were all watching inventories shrink month after month. But what happened? Thursday, silver didn't just break records or edge past the old highs, it doubled the 1980 peak in actual dollar terms, smashing through one psychological barrier after another like they were made of tissue paper. Now let me walk you through exactly what unfolded this week, because the timeline matters and each day built on the previous one, like dominoes falling. Monday, January 20th, marked 1 year to the day since President Trump's return to office. Gold touched $4,747 that morning, already pushing toward historic highs and making headlines on financial networks. That same day, the London Bullion Market Association released their 2026 forecast survey, where analysts from the world's biggest banks and trading houses share their predictions for the coming year. These aren't random guesses. These are professionals who trade millions of ounces daily, people whose careers depend on getting these calls right. The consensus for silver, $79.50 is the average for the year. Remember, this survey came out when silver was trading around $70, so the forecast suggested modest gains ahead. But here's what tells the real story. The range of forecasts stretched from a low of $42 to a high of $165. That spread between the most bearish and most bullish estimate is massive, and it tells you something crucial about market uncertainty. When smart people disagree that wildly, it means something big is happening beneath the surface that traditional models can't quite capture. Wednesday brought news that shifted currency markets in ways that cascaded through precious metals. President Trump announced a framework deal on Greenland, complete with suspended tariffs on European goods as part of the negotiation. The dollar weakened on the news as traders processed what this meant for trade relationships and monetary policy. In precious metals, traders took immediate notice. When the dollar softens, metals denominated in dollars become more attractive to foreign buyers. It's a simple dynamic that plays out every single day, but Wednesday's move set the stage for Thursday's explosion in a way nobody quite anticipated. Thursday morning, 10:47 a.m. Eastern Time, silver crossed $100 and trading screens lit up across the financial world. Volumes surged to historically elevated levels as buyers flooded in from every corner of the market. Retail investors, institutional funds, industrial users scrambling to secure supply. By market close, silver stood at $103.45, an absolute record confirmed by Apomex, Kitco, and every major dealer from New York to Singapore. Gold reached $4,933, inching closer to the $5,000 psychological barrier that traders had been whispering about for months. The entire precious metals complex moved in unison, but silver led the charge with an intensity that surprised even seasoned traders who've watched these markets for decades. Friday brought what markets always bring after parabolic moves, profit-taking. Silver pulled back slightly toward the $100 to $101 range, while gold consolidated near $4,900. But here's what you need to understand. Friday's pullback was normal, healthy even. Markets don't move straight up without pausing to catch their breath. Now, let's talk about the numbers. Wall Street doesn't advertise on CNBC during their afternoon market updates. Silver has gained 43% in just 1 month, from December to January. That's the kind of move that normally takes years to play out in commodity markets. Year over year, we're looking at a 215% increase compared to January 2025, which means if you held silver through last year, you've more than tripled your money. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, now sits at 50 to 1. That's the lowest we've seen in 14 years, meaning silver is finally catching up to gold's performance after decades of lagging behind like the overlooked younger sibling. But here's the number that should grab your attention and make you question everything you think you know about precious metals markets. The paper to physical ratio in futures markets stands at 356 to 1. Let that sink in for a moment. For every physical ounce of silver that actually exists in vaults and can be delivered, there are 356 paper contracts claiming ownership of that same metal. It's like a bank that takes in $100 in deposits but issues $35,600 in checking accounts. Think about what happens when everyone holding those paper contracts decides they want actual metal delivered to their doorstep instead of just electronic entries on a brokerage statement. The system isn't built to handle that kind of demand, and Thursday gave us a preview of the pressure building underneath these markets like a financial volcano ready to erupt. You might be asking yourself, is this sustainable, or are we watching another bubble inflate before our eyes that'll pop just like 1980 and 2011? To answer that question, honestly, we need to look at what's actually driving these prices. Because unlike 1980, when the Hunt brothers manipulated markets with borrowed billions, there's no single villain or master manipulator here. There are 3 structural forces converging right now, and each one deserves your full attention if you're trying to make sense of where silver goes from here and whether your portfolio should care. The first force that's squeezing silver markets is something that's been building quietly for 5 consecutive years. And most investors missed it entirely because they were too busy chasing tech stocks and cryptocurrency. We're talking about a structural deficit in physical supply that has nothing to do with manipulation and everything to do with basic mathematics that even your high school algebra teacher would understand. From 2021 through 2025, the global silver market ran a deficit every single year. Not a surplus where mines produce more than the world consumes. Not a balance where supply meets demand, a deficit where consumption exceeded production month after month, year after year. The total cumulative shortage over those 5 years? 820 million ounces. To put that in perspective, that's the equivalent of one entire year of global mining production just vanishing from available supplies. It's like the world's silver mines took a 12-month vacation, except they didn't. They kept digging, and we still came up short. Here's what makes this deficit particularly concerning for industrial users and investors alike. Mine production has been declining even as demand explodes. In 2025, global mines produced approximately 835 million ounces of silver. Back in 2016, that number was 900 million ounces. We're going backwards in production while the world's appetite for silver keeps growing. And it gets worse when you look at ore grades, which measure how much silver exists in each ton of rock that miners dig up. Those grades are declining across the board as the easy deposits get exhausted and miners have to dig deeper into lower quality ore bodies to extract the same amount of metal. Metals. Focus, one of the most respected precious metals research firms in the industry, put it bluntly in their latest report. Available stocks are abnormally low, and refining capacity constraints limit how quickly recycled material can return to the market. Think about what that means. Even if silver prices stay at $100 and recycling becomes incredibly profitable, there's a physical bottleneck in how fast refineries can process old jewelry, electronics, and industrial scrap back into pure silver bars. You can't just wave a magic wand and turn old circuit boards into deliverable ounces overnight. The second force hitting markets right now is something that changed the entire game on New Year's Day, and most Americans still don't realize how significant this policy shift actually is. China, which controls somewhere between 60 and 70% of global refined silver supply, imposed export restrictions requiring state-approved licensing for anyone wanting to ship silver out of the country. This is not a temporary measure or some political theater. This is a strategic move by the world's manufacturing powerhouse to secure critical materials for its own industries. Let me walk you through the timeline because it matters. On January 1st, 2026, these restrictions went into effect. Hundreds of small exporters who used to freely ship silver to global markets suddenly found themselves locked out, unable to get the necessary approvals. By January 2nd, the bifurcation in the market became glaringly obvious to anyone watching prices carefully. The COMEX March 2026 futures contract, which represents paper promises to deliver silver, was trading at $72.27. Meanwhile, over in Dubai, physical silver coins were selling for $99.93. That's a 38% premium for actual metal you can hold in your hand versus paper contracts that might never convert to physical delivery. Have you ever seen a market split like that before? When the same commodity trades at wildly different prices depending on whether you want paper or physical, that tells you the system is breaking down. It's like discovering that a dollar bill in your bank account buys less than a dollar bill in your wallet. It shouldn't happen in a functioning market, but here we are. Companies like Tesla that need silver for electric vehicle components and solar panel manufacturers that use silver paste in their products are sounding alarm bells. According to industry estimates, if Chinese exports drop by just 50% from historical norms, that would create a deficit of more than 5,000 metric tons annually. There's simply no way to replace that supply quickly from other sources, because silver mining doesn't work like turning on a faucet. It takes 7 to 10 years to develop a new mine from discovery to production. The third force converging on silver markets is perhaps the most explosive, and it is the one that keeps investment banks awake at night. A historic short squeeze that's been building for years. Exchange-traded fund holdings increased by 18% in 2025, adding 187 million ounces of demand from investors who want exposure to silver through their brokerage accounts. Retail demand for physical coins and bars hit record levels as everyday Americans decided they wanted tangible assets instead of just digital portfolio entries. And here's where things get really interesting. Lease rates for silver, which measure how expensive it is to borrow metal for short-term needs, spiked to 30 times normal levels during periods of market stress. Now think about the short positions that major banks hold in silver futures markets. These aren't small bets. We're talking about approximately $4.4 billion in short positions, contracts betting that silver prices will fall. These banks sold futures contracts they don't have the physical metal to back up, assuming they could buy it cheaper later or simply roll the contracts forward indefinitely. But here's the problem. Industrial demand already absorbs 60% of annual mine production. Solar panels, electronics, medical equipment, water purification, electric vehicles, these industries need silver, and they need it now, not next year, when maybe some new mine comes online. If you're a bank holding massive short positions, and you need to cover those contracts by actually delivering physical metal, where exactly do you get it? You need to compete with industrial users, with exchange-traded funds, with retail investors, with Asian buyers, with everyone else scrambling for limited supplies. And because mining production takes years to respond to price signals, there's no cavalry coming over the hill to save you. Covering these short positions would require years, potentially decades, of mining supply at current production rates. Let me draw a comparison that might help you understand whether this is 1980 all over again or something fundamentally different. In 1980, the Hunt brothers cornered the market through pure manipulation. They accumulated physical silver in futures contracts using enormous leverage and borrowed money, artificially restricting supply to drive prices higher. When the commodity exchange imposed Silver Rule 7 limiting position sizes and requiring liquidation-only trading, the manipulation collapsed within weeks. Prices crashed from nearly $50 down to single digits, and the Hunt brothers lost billions while declaring bankruptcy. Fast forward to 2026, and the dynamics couldn't be more different. There's no single manipulator controlling half the world's supply. There's no artificial restriction on deliveries or cornering scheme. What we have instead are genuine structural forces, 5 consecutive years of supply deficits, Chinese export controls that just took effect 3 weeks ago, industrial demand that keeps growing as technology advances, and short positions that banks accumulated over years when they thought silver was going nowhere. The commodity exchange has already increased margin requirements multiple times to cool speculation, but prices keep rising anyway because the fundamentals support higher valuations. Yes, we're seeing volatility that would make most investors nervous. Yes, there will be corrections and pullbacks that shake out weak hands. But the underlying trend is driven by real supply and demand imbalances, not by manipulation that regulators can simply shut down with a rule change. Here's another way to think about it. If you adjust the Hunt brothers' $49.95 peak from 1980 for inflation, that would equal approximately $200 in today's money. We're currently at $103, which means even after Thursday's historic break, silver is still trading at roughly half its inflation-adjusted all-time high. Gold, by comparison, surpassed its inflation-adjusted peak years ago. So which metal has more room to run if this trend continues? The question is not whether silver deserves to trade at $100 based on historical precedent. Clearly, it does when you account for 45 years of inflation and expanding industrial uses that didn't exist in the 1980s. The question is whether the structural forces we've discussed can push it higher still, and whether everyday Americans understand what this means for their retirement savings, their purchasing power, and their financial security in a world where paper money keeps losing value while tangible assets keep gaining it. So let's talk about what you actually need to know right now, cutting through the noise and the hype to focus on actionable intelligence. Because understanding market history is fascinating, but if you can't translate that knowledge into decisions that protect your family's financial future, what's the point? Here are the certainties, the things we know beyond reasonable doubt because the data supports them. First, these supply deficits are not anomalies or statistical flukes. 5 consecutive years of shortfalls represent a genuine trend that won't reverse overnight. When an industry consistently consumes more than it produces for half a decade, that creates structural imbalances that take years to correct even under the best circumstances. Second, industrial demand keeps growing regardless of price because technology companies don't have good substitutes for silver in many applications. Solar panels need silver paste for conductivity. Electric vehicles require silver in their electronics and charging systems. 5G networks, artificial intelligence data centers, medical devices, the modern economy runs on silver in ways that weren't true even a decade ago. Third, and this is crucial for timing, China's export controls went into effect just 24 days ago. We're still in the early stages of understanding how this policy reshapes global supply chains and pricing dynamics. These controls are not going away next month because China implemented them for strategic reasons tied to its own industrial policy and technological ambitions. Fourth, new mining supply takes 7 to 10 years to develop from initial discovery through permitting, construction, and production ramp-up. Even if silver stays at $100 and mining companies rush to develop new projects, we won't see meaningful supply increases until the early 2030s at the earliest. Now, let's look at what the professionals are predicting. And remember, these are not my forecasts. These are published estimates from banks and analysts whose careers depend on getting these calls roughly right. Bank of America's metals strategist, Michael Widmer, published a range of $135 to $309 for silver in a sustained bull market scenario. BNP Paribas, one of Europe's largest banks, projects $100 by the end of 2026, which we've already hit in January. The London Bullion Market Association consensus forecast showed $79.50 as the average for the year, though that survey was completed before Thursday's breakout. Gold-silver analysts, who focus specifically on precious metals, are targeting $175 or higher. And there are outlier forecasts reaching as high as $300 if supply constraints intensify and industrial users start panic buying to secure inventory. Here's what you need to understand about these forecasts. They are not buy recommendations, and I'm certainly not telling you to rush out and mortgage your house to buy silver at all-time highs. These are analytical assessments based on market fundamentals, supply-demand dynamics, and historical precedents. Professional analysts get paid to crunch numbers and model scenarios, not to give financial advice to individual investors with unique circumstances. Your situation, your risk tolerance, your time horizon, your other investments, these factors matter far more than any analyst's price target. Let's talk about risks, because if someone's only giving you the bullish case without discussing what could go wrong, they're either trying to sell you something or they don't understand markets. The first and most obvious risk is extreme volatility that can wipe out paper gains before you have a chance to realize them. Silver's rally has been parabolic, moving almost vertically on the charts over the past month. History teaches us that gravity hits parabolic markets when nobody expects it, often at moments of maximum bullishness when everyone thinks prices can only go higher. If you bought silver at $103 on Thursday and it drops 20% in a week, are you financially and emotionally prepared to hold through that drawdown? Because that's not a hypothetical. That's the kind of volatility silver delivers regularly. The second risk showed up Friday when profit-taking hit the market. Silver dropped from $103 to the $100 to $101 range in a single session as early buyers decided to lock in gains. That's completely normal and healthy in a bull market. Prices don't move straight up without pausing. But it also reminds us that corrections of 10 to 20% can happen even when the long-term trend remains positive. If you're using leverage, or if you need that money in the near term, those kinds of moves can be devastating. The third risk involves potential policy changes that could alter the supply-demand equation. What if China lifts its export controls 6 months from now after securing whatever strategic objectives motivated them in the first place? What if a global recession reduces industrial demand for silver even as supply stays constrained? What if new mining production comes online faster than expected, though, as we discussed, that seems unlikely given development timelines? Markets are dynamic systems where conditions change, and being positioned for one scenario while a different one unfolds is how investors lose money even when they understand the fundamentals. The fourth risk relates to the gold to silver ratio, which currently sits at 50 to 1. Historical ranges typically fall between 40 and 60, meaning we're already near the lower end of normal. If gold stagnates or corrects while silver continues climbing, that ratio could compress further into territory that might trigger mean reversion. Or conversely, if gold surges to $5,000 and beyond while silver consolidates, the ratio could widen again, which would feel painful for silver holders watching gold outperform. So what should American investors actually do with this information? If you already own physical silver, the first step is evaluating your overall exposure. Financial advisors typically recommend precious metals represent no more than 10 to 15% of a diversified portfolio, though some circumstances might justify higher allocations. If Thursday's move pushed you above your target allocation because of price appreciation, you might consider taking some profits to rebalance. Not because silver is going to crash necessarily, but because maintaining portfolio discipline matters more than trying to time perfect exits. If you're sitting in cash wondering whether to jump in, here's my honest assessment. Buying at $103 at all-time nominal highs requires serious conviction and a strong stomach for volatility. The FOMO, fear of missing out, is real right now, and FOMO has destroyed more portfolios than any market crash ever did. If you believe in the long-term structural story, dollar cost averaging makes far more sense than trying to time a perfect entry. Maybe you allocate a portion of your intended position now and spread the rest over the next 6 months, buying on pullbacks that will inevitably occur. That approach reduces your risk of buying the exact top while still getting exposure if the trend continues. One more thing for American investors to watch closely. The Federal Reserve meets Monday and Tuesday this week. Markets are expecting a pause on interest rate changes, with rates holding steady while the Fed assesses economic data and inflation trends. But any surprise in either direction, more hawkish if they hint at rate hikes to defend the dollar, or more dovish if they signal concerns about growth, will impact precious metals immediately. And here's something most people don't realize. Federal Reserve Chair Jerome Powell's term expires in May, just 4 months from now. His final meetings carry extra weight as markets try to read between the lines about future Fed policy direction. Pay attention to Powell's rhetoric about dollar strength in his press conference. If he expresses concern about the dollar's decline, or suggests the Fed might need to act to support it, precious metals could pull back sharply. If he downplays dollar weakness and focuses on domestic employment and inflation, that's generally supportive for gold and silver. The currency market is the invisible hand that moves precious metals daily, and most retail investors completely ignore it. Thursday, January 23rd, 2026 will be remembered as the day silver finally broke free from 45 years of resistance and psychological barriers. But unlike 1980's manipulation-driven spike that collapsed within weeks, this move is backed by 5 years of structural deficits that have drained available inventory. It's supported by Chinese export controls that went into effect just 24 days ago and fundamentally altered global supply chains. It's driven by industrial demand that's only going to grow as our economy electrifies, digitizes, and builds out renewable energy infrastructure that requires silver in quantities previous generations never imagined. At $103, we're making history and setting records that seemed impossible just a few months ago. But with analyst targets ranging from $135 to $309, and with physical silver trading at 38% premiums to paper contracts in some markets, the question facing American investors isn't whether silver continues higher in the long run. The question is, how much volatility can you stomach on the way? And are you positioned in a way that lets you sleep at night regardless of whether tomorrow brings another surge or a sharp correction? This week, as the Federal Reserve meets Monday and Tuesday in chair, Powell faces his final meetings before his term expires in May. Precious metals markets will be watching every word, parsing every phrase for hints about dollar policy and interest rate direction. Because in a world where paper trades at $72, while physical coins sell for $100, where 5 years of deficits have drained supplies, where the world's largest refiner just restricted exports 3 weeks ago, something fundamental has broken in the machinery of global silver markets. But here's what Thursday's historic break really signals. And this is where we need to zoom out from silver specifically and look at the bigger picture reshaping global finance. What happened with silver is a symptom of something larger happening to the entire monetary system that has governed world trade since World War II ended. Look, I'm not saying the dollar collapses tomorrow or that you should panic and convert everything to gold bars buried in your backyard. But when 10 nations representing half the world's gold production launch a gold-backed settlement currency for international trade, when central banks buy 1,000 tons of gold 3 years in a row, setting absolute records, when 90% of Sino-Russian trade bypasses the dollar entirely using yuan and rubles and gold for settlement, that's not conspiracy theory cooked up in internet forums. That's data. That's momentum. That's the patient, methodical reordering of global finance happening in real time while most Americans focus on their daily lives and assume the dollar's dominance is permanent and guaranteed. And if you're American, especially if you're protecting decades of savings accumulated through hard work and careful planning, you need to understand these forces. You need to recognize that the world's monetary system is being rewired, quietly and systematically, with gold and other tangible assets at its center rather than at the periphery where they have sat for the past 50 years. The BRICS nations aren't just talking about alternatives to dollar trade, they're building the infrastructure, signing the agreements, conducting the transactions. The question isn't if the dollar loses its dominance as the world's reserve currency. The question is, are you positioned for when it does, or are you going to be caught holding assets denominated in a currency that buys less with each passing year? Silver crossed $100 Thursday because supply and demand fundamentals finally overwhelmed paper market manipulation and decades of price suppression. But silver crossed $100 Thursday because the entire framework of fiat currencies, backed by nothing but government promises, is showing cracks that get wider every month. Are you positioned for what comes next? Or are you still watching from the sidelines as history is being written, hoping somehow your dollar-denominated retirement accounts maintain their purchasing power, while central banks worldwide scramble to accumulate the real money that served humanity for 5,000 years? Hit subscribe if you want more no BS analysis of where these markets are really headed, because this story is just beginning. And the next few years will determine whether Americans maintain their wealth or watch it evaporate in the currency wars already underway. Drop a comment. Do you own physical metals, or are you all in on dollar assets? Because that conversation matters more than any price prediction or technical analysis chart ever will.